market indicators. In that, total 5 indicators are there. The first one is called breadth index. The second is volume of transactions. The third one is confidence index. The last one is relative strength analysis. And the next is odd lot theory. So what is that in the breadth index? Let us have understanding. Dear students, as far as the breadth index is concerned, it is like a kind of ratio which is calculated. The ratios are calculated, that is, this ratio is calculated as like advances minus declines divided by total number of trades. That is how it is calculated. In a way that we understand that whatever the stocks during the period have gone up minus whatever the stocks whose value has gone down, difference of that is calculated, divided by the total number of trades. Total number of trades will include three things: number of securities for which the price increases, price decreases, and the third one is the prices are remaining same. That is the way the breadth index is calculated. It is an index that covers all securities traded. That is, this is all securities traded. It is computed by dividing net advances or net declines. Net advances means advances minus decline. Net decline means decline, that is the advances minus decline. So whatever the differences in the market by the number of issues traded, that is over here total number of trades. The breadth index either supports or contradicts the movement of the Dow Jones averages. Dear students, we have understood that so the two Dow Jones averages, that is industrial and the transportation. So over here we understand that whatever the breadth index that we compute, that may support the Dow Jones industrial average. Means if at all the breadth index is also increasing along with the increase say in the Dow Jones industrial average, then in that case this is indicating that Dow Jones industrial average is indicating the correct situation. And if it is reverse, then in that case it is not indicating the correct situation. If it supports the movement of the Dow Jones averages, this is considered sign of the technical strength, and if does not support the averages, it is a sign of the technical weakness. So with this we will be able to know that whether the Dow Jones industrial average is indicating the correct situation or not. That is a sign of the market will move in a direction opposite to the Dow Jones averages. The breadth index is an addition to the Dow Jones theory and movement of the Dow Jones averages. So over here friends, you can see that the advances and the declines information that you will be able to find in the National Stock Exchange. That is, in the month of January, advances are 1064. So 1064 minus decline is 1069. So the difference is 5. It may be positive, it may be, that is say negative, that does not make any sense. This 5 divided by the total number of trades. What is the total number of trades? That we do not know. However, this ratio is 0.99. So divided by 0.99 I am doing, that comes to that is over here 1064 minus 1069 divided by the total number of trades, and that ratio is 0.99. Yeah, that is the way the advance decline ratio is there over here. However, the breadth index is calculated as the difference of these two divided by the total number of the trades. This is the way we have the advances and the declines in the market. This is not the breadth index, but this is like the advances and decline information with which we can compute the breadth index. So it is advances minus decline, difference of both of them, divided by the total number of trades. Let us assume that the total number of trades are equal to the summation of these two. Then 1064 plus 1069. So 2133 is the total number of trades. So 5 divided by 2133 into 100. So in that case, the breadth index will be 0.2344 percentage. This is the way we are required to calculate. Volume of the transaction. Now what is the volume of the transaction? Let us understand. We understand, friends, that say we have seen two types of candles. Basically we have seen like green candle and we have seen like red candle. Green candle is basically indicating that the prices are moving up, and red candle is indicating that the prices are moving down. This is what we have understood. Nothing is special in this case, as we already have discussed it. Now what happens that if at all the prices are going up, along with that the volume of the transaction is high, then in that case we can say that really the market is going up and the price of this security is going up substantially, in a way that the number of traders want to buy the share, and with that the price of the security increases. Further we understand that something like this, that if at all the prices are going up, however if at all the volume is down, then in that case we understand that still the sentiment is not so strong about the price of the security to go up. Like for example, if at all we are reviewing a product, say regarding its comment, if at all we have the number of comments which are positive of 5-star rating, then in that case we have an assurance that yes, the product is really doing well. If at all the rating 5 is there, however the number of customers who have gone to that restaurant are very less, then in that case we are not so confident to go in that restaurant. Exactly the same thing is applicable. If at all the prices are falling down and the volume is very high, then in that case definitely it is an indicator that the price of the security will definitely fall down and the company is really not performing well. And over here, if at all the prices are going down but the volume is less, it indicates that yes, prices have gone down, but yet we cannot say that the company is facing very bad situation in the market. So keeping this in mind, let us read this paragraph. The volume of the shares traded in the market provides useful clues on how the market would behave in the near future. A rising index of the price with increasing volume would show an indication buy behavior, but the situation reflects an unsatisfied demand in the market. Similarly, falling market with the increasing volume, increasing volume is indicating a strong signal. Signals a bear market and the prices would be expected to fall further. A rising market with a decreasing volume indicates a bull market, while a falling market with dwindling volume, that is less volume, indicates a bear market. Thus, the volume concept is the best used with another market indicator such as Dow Jones theory. See over here we are having a random stock in which we can understand something like this. You can see that in the month of February, you can see that there is a red line. You can see that there is a red line. Now this red line is indicating that the prices have gone down substantially, and along with that you can see that there is a huge volume. So that volume is indicating that yes, the prices have also gone down, and along with that the number of traders who are doing the transaction is also very high. This is what's the kind of indication that we get. So below this, the blue line, the blue, that is the arrow line, what you have is that the volume is very high or volume is very low. So that is indicating the volume. and above than that, so the candlestick chart is drawn. So that candle is indicating the price movement of the security, and below this, that is below the blue line, you can see that you have been provided with the volume. So if at all the prices are falling down and along with the high volume is indicating that yes, definitely the company is having a very bad situation. So again, this is one another diagram that we have, in which we can see that the price increase decreases, which is shown by the red and the green candle, and below than that the volume is there. If at all the volume is very high, then in that case it is supporting that yes, the prices are actually going up or actually going down. Next, confidence index. Now the confidence index is something which is absolutely different. It deals about the returns of like the debt bond, that is the debt security, and based on that the confidence index is calculated. So over here what we are doing, we make the calculation of the average return of, let us say, AAA bond divided by average return of, let us say, BBB bond. AAA is indicating that these securities are having the very high, that is the high credit rating in the market, and BBB is indicating that they are not having that much credit rating. Credit rating depends upon the number of factors, that includes that the timely payment of the all the dues, your financial condition, your net worth. There are number of parameters based on which you are able to gain the rating. That is what we understand is a AAA rating, BBB rating, and so on. Number of ratings are there. So the confidence index is basically calculated using these kind of returns, and it is indicating the overall economic situation. It is supposed to reveal how willing the investors are to take chance in the market. The ratio of the high grade bond yield to low grade bond yield. High grade means AAA. Low grade means comparatively lower. Let us say BBB or CCC, something like that. It is used by the market analysis as a method of the trading or timing the purchase and the sale of the stock, and also as a forecasting device to determine the turning points of the market. A rising confidence index is expected to precede a rising stock market, and fall in the index is expected to precede a drop in the stock prices. So if at all it is rising, then in that case it is a signal of bull, and it is dropping, it is a signal of bear. A fall in the confidence index represents the fact that the low grade bond yields are rising faster or falling more slowly than the high grade bonds. The confidence index is usually but not always a leading indicator of the market. Leading means that some signals are there before the market is falling down or that is going up. Therefore, it should be used in conjunction with the other market indicators. So what happens that you take 10 securities of AAA rated securities and you find its return. Let us say it is 6%, and you take 10 securities of the BBB rating and you find its return, let us say it is 9%. Then in that case this ratio is 0.75. This is the way the ratio is calculated, and with the change in the ratio, you will be having this kind of the future indication. Relative strength analysis. Now the term relative means in comparison to somebody. So over here, the kind of the analysis that we do is like this. We make the computation of, let us say that's the performance of the TCS vis-a-vis Sensex. Suppose over the time period of, let us say, last 1 year, the Sensex has given return this much, and in comparison to that, the TCS has given return this much. Then in that case, the TCS has outperformed the market. This is what we understand is a relative strength. As far as the relative strength is concerned, it is calculated as percentage change in return of security divided by percentage change in return of the market. This is the way the relative strength is calculated. The relative strength concept suggests that the prices of some securities rise relatively faster. Okay, so percentage change. And over here you can see that it provides the relatively in bull market or declines more slowly in a bear market. So prices are rising, then it rises at a faster rate, and when it is falling at a lower rate. So that is a good signal, so that security is relatively better. Then other securities, that is some securities exhibit relative strength. As far as this percentage change in the return on the market portfolio is concerned, it may be of the any indices also. Investors will earn higher returns by investing in securities which have demonstrated the relative strength in past, because the relative strength of a security tends to remain undiminished over time. So it is usually outperforming the market or maybe a sector. Relative strength can be measured in several ways. Calculating the rates of return and classifying those returns with the historically high average returns as the securities with high relative strength is one of them. Even ratios like security relative to the industry and security relative to the entire market can also be used to detect the relative strength in a security or an industry. So here you can see that the relative strength can be that is shown like something like this, wherein what kind of performance is there of the market and what is the performance of a specific security, that we can see over here. This is what's the relative strength. Over here the green line and over here the blue line are indicating basically the relative strength. Next is odd lot theory. Odd lot theory is having a kind of explanation in this way. As for this theory, there are two types of traders in the market. One is investors, and investors are having a kind of the proper analysis, and afterwards they make investment in the market. They take proper call, they take the proper situation in the market after making proper analysis. And except investors, we can say that there are speculators. Basically we understand that the speculators are more like inclined for the stock market, or they are entering into the stock market just with an intuition to make some supernormal profit. They do not have the proper studies, they do not have the proper knowledge of the stock market or the stocks, and they enter into the stock market. We can say that as per this theory, the investors are divided into two parts: those who are educated and those who are uneducated. That is the way the two bifurcation is there. This theory says that basically the educated or the investors are going to make proper investment in the stocks. They will make investment in, let us say, in multiple of 100. That is a kind of the explanation given by the theory is that they will make proper investment in some the proper number. Let us say it is in multiple of 100. And these investors are not having that kind of the proper, or we can say that the discipline, and they buy the security in any number. They buy 6 shares, they buy 106 shares, they buy 258 shares, they buy 18 shares, like that. They buy the securities in odd lot. Now we understand that usually if at all we go rationally, then these investors may be able to make a gain that is by chance. However, these investors are definitely that is going to make a gain. This is what we understand. So these investors who are going to make a gain by chance, we understand that say usually say they will be incurring a loss. Most of the time these investors decision will go wrong. So this theory says that say we have to identify that say what is the odd lot traders in the market, and whatever they are doing, do opposite to that, and with that say you will be able to make a gain. This theory is contrary opinion theory. Okay, contrary opinion means opposite opinion. Whatever they do, do reverse of that. It assumes that say the average person is usually wrong, and that a wise course of the action is to purchase the strategy contrary opposite to the popular opinion. The odd lot theory is used primarily to predict the tops in the bull market, but also predict the reversal in the individual securities. So you can see that say, this is say, the odd lot theory diagram, in which say the number of traders who are trading in odd lot and number of traders who are trading say in proper lot, so that diagram is given. Similarly, this is also a diagram for odd lot, so the trading with respect to the number of traders. So you can see that once again over here, so the portfolio of an odd lot trader is like 53, 81, 51, 95, 20, and for say a wise investor 100, 100, 300, 300, 200. So this is what say they have is a kind of say the number of shares which is in multiple of 100 usually. Support level means the price will not fall below than this. Resistance level means the price will not increase beyond this point. Okay, this is what say we already have discussed a point. This is the support level because the prices are not falling that is below this, and this is the resistance, the price is not going below that is above this point. We understand that say basically that say over here at this point of time say some bad news about the security comes into the market, and because of that say the prices are falling down, falling down, falling down. Now at this by this time what happens that say the market realizes that say definitely say this security is not so bad that its price should fall say that is below this point. So what happens that say the number of buyers now become more strong in the market in comparison to the number of sellers, and because of that say from here the price is moving upward. So this is the support level. We understand that say the number of buyers becoming strong, and because of that say the price is now moving up. The price is moving up, moving up, moving up. Let us say it is moving up. Now at this point of time what happens that say the number of traders believe that say the security is now overpriced. The price of the security cannot go beyond than this. So you start booking your gain. So you sell your investment, and because of that say due to price pressure or due to increase in the number of sellers in the market, the price of the security is now falling down. The number of buyers are becoming weak at this point of time. They will not be able to buy the security, say the supply which is there in the market. So the price of the security is falling down. Of course, looking to say this diagram, we understand what we should do. We should say at this point of time we should buy the security. At this point of time somewhere we should sell the security. This is what's the support and resistance level. That is what we have. When an index of the price goes down, it is falling down from a peak. The peak becomes the resistance. Okay, the maximum level is becoming the resistance. When index of the price rebounds, okay, it is going up, that is from a certain point of time. After reaching trough subsequently, the lowest value reached becomes the support level. The price is then expected to move between these two levels. Whenever the price approaches the resistance level, there is a selling pressure because all investors who failed to sell at high level would keen to liquidate. Whenever the price approaches to the support level, there is a buying pressure as all those investors who failed to buy at the lowest level would purchase a share. A breach of these levels indicates distinct departure from the status quo and attempts to set the newer levels. Now friends, we understand that say at this point of time we are expecting the price to go up. However, it may happen that say it is falling down further and then it is moving up. Something like this. So what happens that say there is a new support level and new resistance level. At the same time we understand that say over here say again the prices are going up and then it is falling down, something like this. So what happens that say there is a new resistance level and new support level and new resistance level. So it is not like that say the once these levels are established it is going to be that only forever. There are definitely chances that say these levels say will be re-established, considering the situation of the market, considering the situation of the company, considering the news of the company. So these levels will keep on changing in the market. That is what we have. Let's get a better understanding about these levels by using the price data about 2 months for the shares of the company A and B given in the following table. So here you can see that say the lower one is say indicating the support and the higher one is indicating as say the resistance. Once say these levels are definitely likely to change and there will be a new support level and new resistance level. Again we have a next diagram and wherein you can see that say the prices are say moving in say certain range only. Then in that case say the lower one, that is the blue line, is indicating the support level and the red line is indicating the resistance level. However, what happens at say at this point of time, the support level say got cracked and say the prices went down further. So in that case what happens at say we understand logically the number of sellers say have increased in the market and because of that say the prices say fell down further. So of course we cannot say every time that say whatever the decision that we take at this point of time will always prove to be correct, because say when the prices say were this, at that point of time if at all you have purchased the security with that is with a point that say the price will now increase, however your like expectation may not prove to be correct. This is one more diagram wherein you can see that say that is say the support and resistance. So over here whatever these prices are there, taking that into account, say this kind of line chart is drawn. So it is like this. The line chart of company A and B shares are shown in the graph below. From the chart it appears that say the support level and the resistance level for A and at the time were about 100 and 125. So for company A, wherein this dark line is there, so it is 100 and so this is 125. This is in case of A, and for B it is 140 and 160. So for B it is 140 and it is 160. This is what say we have the support and the resistance level. Next is interpretation of the price pattern. Friends, over here say certain price patterns have been provided to us. The first one is channel, next is wedge, then head and shoulders. Head and shoulder top pattern, inversion head and that is inversion head and shoulder pattern, triangle or coil formation, flag and penitence form, double top form, double bottom form, and gap. These are the things that they have provided. Now friends, over here what I am expecting that's in examination, you would be provided with a specific channel to be explained, and not that say you are required to just say tell us about the few price pattern. So you'll be provided with a specific, and in that case say you are required to give answer. So understanding them, there are numerous price patterns documented by the technical analysis, but only a few and the important of them have been discussed here. So there are number, but over here we are going to discuss a few as per the institute syllabus. Channel: a series of uniformly changing tops and bottoms give a rise to a channel formation. A downward sloping channel would indicate the declining in the prices, and upward, that is say sloping channel, would imply rising in the prices. So this is a channel wherein it is going in the upward direction, then in that case it is bullish, and if it is downward, that is the direction, it is bearish. So over here we can see that say this is the channel which is indicating that the ups and downs say going in the upward direction. So they have provided over here when to enter and when to exit in this kind of situation. So it is up channel, down channel, up channel, down channel. In that also we can understand that say you are expecting this price to price changes to remain constant. That is the reason say when the prices are going down, you should buy, and then you should go, that is buy, so sell when the prices have already reached to the up level. You can see that say the rising channel, and there is a breakout that they have given. Breakout means that say now this kind of the price movement is not there, so we have a different kind of price movement. That is what say we understand. Again say these are the different like the using the candlestick chart, this kind of price pattern is drawn. Wedge: a wedge is formed when the tops resistance level and bottoms support level changes in opposite direction. Means we understand that so the resistance level is going down and the support level is going up. That is if the tops are decreasing and the bottoms are increasing, and vice versa, or when they are changing in the same direction at different rates over the time. This is what say we understand is a diagram for the wedge, wherein say it is say the narrowing. So here you can see that say there is the upper diagram is provided regarding the prices, and so the lower diagram is provided for the volume. These are the practical diagrams that say we can see, wherein say again the support level is going up and the resistance level is going down. This is what you can see. These are the different price patterns. Next is head and shoulders. Head, shoulders. With that, so we will see a kind of diagram. It is distorted drawing of a human form with a large lump for the head. So this is indicating the head. In the middle of the two smaller humps for shoulders. So the two smaller humps for shoulders. It is perhaps the single most important pattern to indicate the reversal of the price trend. So now if at all there is say a head and shoulder formed, then in that case the price is now going to have a reversal situation. The neckline, this is the neckline of the pattern, is formed by joining points where the head and the shoulder met. The price movement after the formation of the second shoulder is crucial. So after this the price formation is crucial. If the price go below the neckline, the drop in the price is indicated. So it means that the price will definitely fall down, with the drop expected to be equal to the distance between the top of the head and the neckline. That is, say we are expecting, so this time the reduction in the price equal to this much. If at all the prices are reducing say below this, this is for say the kind of the chart analysis that say we have. For the head and shoulder top pattern, this has left shoulder, that is over here, it has left shoulder and right shoulder. Such formation represents bearish movement. If the prices fall below the neckline, line drawn tangentially to the left to right shoulder, a price decline is expected. Hence, it is a signal to sell. So now you should sell this investment. Inverse of the head and shoulder pattern. So you can see that say this is inverse, means instead of something like this, you have say something like this. It is inverse, so exactly opposite to that. As the name indicates, in this formation, an inverse of the head and shoulder top formation. This is head and shoulder top formation, this is top, and this is bottom. It reflects a bullish movement. Now the prices will go up. The price rise above the neckline, that is above the neckline, suggests the price is rise is imminent and signal to purchase. So now the price will further go up. So you should buy the security. This is what it says. So here you can see that it is the head, that is the middle one, two shoulder, and say that this is the neckline. This is what we understand is the like the top head and shoulder pattern, wherein you can see that say below the neckline, say the prices are now falling down, so the price will further fall down. So this is the point at which you should sell the investment. Again, it is the top head and shoulder pattern, wherein say the above one is indicating that say the head, two shoulder, and the prices are falling down say below the neckline. So it is indicating that say a signal to sell. In this diagram we have both the things. The left hand side, say the color in which you can see that it is the top head and shoulder, and on the right hand side you can see it is the bottom head and shoulder, that is inverse of the head and shoulder pattern, wherein again when the prices are increasing say above the neckline, then in that case it is a signal to buy, so you should make a purchase. This is what we understand. Next is a triangle or coil formation. You can say that this is a triangle. Okay, this is the flat one. This formation represents a pattern of uncertainty, and it is difficult to predict which way the price will break out. So over here, say it is difficult that say where the price will change. So again we have ascending, descending, and symmetrical triangle, that is the triangle. So you can see that say they have explained that say the prices may change in any moment, that is it may go in any direction. Ascending, descending, and symmetrical. Breakout is indicating that say now this kind of say the price changes are not there, something else is there. And we already have understood one thing, friends, that say these kind of the candlestick chart can be drawn for any time period. It may be for 1 minute, it may be for 1 day, it may be for 1 hour. So whatever the kind of say the investment that say you are going to have, based on that so you are required to form the candlestick chart to take the decision. The next is a flag. Okay. You can see that it is a kind of flag. This is flag. This is what they want to say. This is again a flag. Flag and pennant form. This form signals a phase after which, so once this phase will complete, the previous price trend is likely to continue. So the price was moving up, a flag is formed, now again the price will move up. That is what it says. Price moving up, flag is formed, again the price will move up. So you can see that say the prices are moving up, a flag is formed, and then the prices are again moving up. So you can see that again the price is going up, then flag is formed, again the price will go up. This is what say they want to mention. So you can see that again a flag is formed and the price will move in the same direction. So it is the flag during upward trend, flag during the downward trend. The next is the double top form and double bottom form. This is double top. This form represents the bearish movement, signals that the prices are expected to form, that is fall. So after two top, the prices are falling down. Double bottom, it represents bullish development, signaling the price is expected to rise. So the prices have gone down, so now it will go up. So over here, this is what's the double top. Then the prices will fall down. Double top. The two, like the, we can say that's the double top, and then the prices are falling down. Again, say the two top, and then the price will fall down. So this is what you can see, that's the two bottom, double top, that is a bottom, that is what you can see. Next, a gap is the difference between the opening price on a trading day and the closing price of the previous trading day. Now the price at which yesterday the market was closed and today the price at which the market started for that security is a gap. The wider the gap, the stronger the signal of the situation of the observed trend. Many times you might have heard that say certain events are taking place internationally, and because of that say the next day then the market is open, it opens at a different level than the price at which it was closed previous day. This is what say we understand is say the gap. Friday evening when the market is closing and Monday morning at which it is opening, we know that say the 2 days is a like the huge time gap as far as the stock market is concerned, and because of this so the gap will be very wider. On a rising market, opening price is considerably higher than the previous closing. It indicates that the investors are willing to pay a much higher price to acquire the scrip. Similarly, the gap falling market is indicated extremely selling pressure. So you can see that so the gap in the prices is shown over here, so in the circle. Again, you can see that so there is a gap between the closing price of the previous day and opening price of the next day. This is the gap you can see. Prices are falling down, then in that case it is indicating that so the selling pressure is there. Prices are going up, then in that case it is the buying pressure. You can see that the huge gap is there. Now we are entering into a segment in which we are going to have understanding say of certain calculations. We are going to have understanding of say certain numericals with respect to this point. Decision using data analysis. Technical analysis have developed rules based on simple statistical analysis of price data. Moving averages is one of the more popular methods of data analysis for the decision making. तो मूविंग एवरेज में क्या होता है? I give you some explanation like this. जो प्राइस चेंजेस ऐसे होता है ना, वो प्राइस चेंज को वो कन्वर्ट करके हमको देता है कुछ ऐसे. So we can have a signaling that say where the prices are heading upon. This is what we understand is a simple moving average. Let us read certain content. With that, we will have that is a better idea. उसका न्यूमेरिकल कैसे होता है फ्रेंड्स? जैसे कि हमको 1 2 3 4 5 दिन का जो क्लोजिंग प्राइस होता है ना, इंपॉर्टेंटली क्लोजिंग प्राइस, उसका एवरेज किया जाता है 5th डे के एंड पे। 6th डे पे क्या किया जाएगा? 2 to 6 का क्लोजिंग प्राइस है, उसका एवरेज किया जाता है। 7th डे पे क्या किया जाता है? 3 to 7 के क्लोजिंग प्राइसेस का एवरेज किया जाता है। दिस इज व्हाट वी अंडरस्टैंड इज द एवरेज कैलकुलेशन, और उसके ऊपर से हम लोग डायग्राम बनाते हैं। Moving averages are frequently plotted with the prices to make buy and sell decision. The two types of moving averages used by the chartists are arithmetical moving average. Arithmetical का मतलब क्या होता है? सिंपल मूविंग एवरेज, यानी इस पर टोटल किया जाएगा कुछ प्राइसेस का और उसका एवरेज किया जाएगा। एंड एक्सपोनेंशियल मूविंग एवरेज, एक दूसरा भी मेथड होता है एक्सपोनेंशियल मूविंग एवरेज, क्यों वो भी हम लोग समझने वाले हैं। एंड एन पीरियड एवरेज मूविंग एवरेज, सॉरी अरिथमेटिकल मूविंग एवरेज। एन पीरियड क्या हो सकता है? कुछ भी हो सकता है, वो 10 दिन भी हो सकता है, 50 दिन भी हो सकता है, 200 दिन भी हो सकता है, कुछ भी हो सकता है। एट टाइम पीरियड टी is nothing but the simple average of the last n period prices. देखो लास्ट n पीरियड प्राइसेस, तो क्या किया जाएगा? ये जो भी नंबर ऑफ डेज लेने हमको, उसका क्लोजिंग प्राइसेस और उसका 1/n। आइडेंटिफाई ट्रेंड, टेक्निकल एनालिसिस आर यूज्ड, मूविंग एवरेज एनालिसिस, टेक्निकल एनालिसिस यूज मूविंग एवरेज एनालिसिस। A 200 days moving average of daily prices or 30 weeks moving weekly price for identifying the long term trend. तो 200 दिन का प्राइसेस लिया जाएगा for like identifying the long term trend, या तो 30 weeks का moving average, 60 days moving average of the daily prices to discern an intermediary term, 10 days moving average of the daily price to detect द शॉर्ट टर्म ट्रेंड। तो आपको टाइम पीरियड सेलेक्ट करना है, उस हिसाब से आप मूविंग एवरेज कैलकुलेट करोगे। फॉर एग्जांपल, मूविंग एवरेज इज कैलकुलेटेड बाय कंसीडरिंग द मोस्ट रीसेंट ऑब्जर्वेशन फॉर व्हिच द क्लोजिंग प्राइस, बी केयरफुल दैट वी हैव टू फोकस ओनली ऑन द क्लोजिंग प्राइस ऑफ 10 सक्सेसिव ट्रेडिंग डेज आर टेकन इनटू अकाउंट फॉर कैलकुलेशन ऑफ 5 days मूविंग एवरेज ऑफ द डेली स्टॉक प्राइसेस। तो देखो ये 5 दिन का क्लोजिंग प्राइस है ना, उसका एवरेज किया जाएगा। दैट इज सबसे पहले उसका टोटल किया गया, $25 + 26 + 25.5 + 24.5 + 26, तो ये टोटल कितना है? 127 डिवाइडेड बाय क्या किया जाएगा? डिवाइडेड बाय 5, दैट इज से 25.4। That is what we understand is a simple moving average for 5 days. फिर 26, तो उसमें क्या किया जाएगा? We understand 127 minus 25 plus 26, तो ये 5 दिन का क्लोजिंग प्राइस आ गया। And that is the way we are supposed to do the calculation of the sum, 2 items central total, एंड उसके ऊपर से हमने मूविंग एवरेज कैलकुलेट किया है। नेक्स्ट, बाय एंड सेल सिग्नल प्रोवाइडेड बाय द मूविंग एवरेज एनालिसिस। तो बाय कब करना है? एज पर द मूविंग एवरेज, स्टॉक प्राइस लाइन राइज थ्रू द मूविंग एवरेज लाइन व्हेन द ग्राफ ऑफ द मूविंग एवरेज लाइन इज फ्लैटनिंग आउट। स्टॉक प्राइस लाइन फॉल्स बिलो द मूविंग एवरेज लाइन व्हिच इज राइजिंग। Stock price line which is above the moving average line falls but begins to rise again before reaching to the moving average line. So friends, here is the that is the simple moving average for 50 days. तो अब देखो कितना फ्लक्चुएशन ऑफ द प्राइसेस है, पर इन्होंने बहुत स्मूदन कर दिया से ये प्राइसेस को। ये 200 पीरियड का पास्ट 200 क्लोजिंग प्राइसेस को लेके है। देखो यहाँ पे 5 दिन का, 30 डेज का, 62 डेज का सिंपल मूविंग एवरेज है. This is again we have the 200 days and 50 days. 200 days is for long term and 50 days for short term. These are again the different, so the simple moving average. तो फ्रेंड्स ये 3 सिचुएशन में से आपको सिक्योरिटी बाय करना चाहिए. कौन से 3 सिचुएशन में? When the stock price line rises through the line of the moving average line, when the graph of the moving average line is flattening out, ये सिचुएशन में. दूसरा, stock price line falls below the moving average line when it is rising, तो अभी वो that is it is going to now say the cut that line. Stock price line which is above the moving average line falls but again begins to rise before reaching to the moving average line. So we understand, let's say this is the moving average and say it says that say it is going up but still it has not crossed this. So at this point of time you should buy it. Sell signal. Stock price falls below through moving average line when the graph of the moving average line is flattening out. Stock prices line rises above the moving average line which is falling. So the price is already up and now it is falling down and yet it has not touched the moving average. Stock price line which is slow moving average line rises but begins to fall again after reaching the moving average line. The next is the exponential moving average. So a kind of say the advanced version of the moving average. So it says something like this, that what happens at say in simple moving average, so all the prices are given equal importance. So exponential moving average says that say we should give more importance to the current price change in comparison to say all the prices. This is what say the exponential moving average says. So listen carefully, it says something like this. Suppose on a particular day you are calculating the simple average. Suppose on day 5 you have calculated the simple average, let us say it is 1000. It means that on day 6 you are expecting the price to be 1000. However, it may happen that the price is different than 1000. So in that case we understand that the exponential moving average says that say we have to do something like this. Suppose this is 1200, for example, this is 1200. Then the closing price of 1200 minus the previous exponential moving average 1000 means you are expecting it to be 1000 but actually it is 1200. So this difference is required to be multiplied with a multiplier. That multiplier is calculated as 2 divided by n plus 1 and this is added to 1000 in order to calculate the new exponential moving average. The formula is having a logic like this. Listen carefully. We were expecting it to be 1000 but actually it is different. So whatever the difference that we have, so that difference is required to be like adjusted set to this previous exponential moving average in order to compute the new exponential moving average, that is the expected price for the next day. And this is multiplied with 2 divided by n plus 1, that is multiplied because the recent price change is given the maximum importance, is given double importance in comparison to the previous prices. N is indicating the number of observations, 1 is indicating that say usually we have the weight of 1 divided by n, but since the numerator is 2, that is the reason it is n plus 1, that is the weight is assigned to the recent change. Unlike, so not the way arithmetical moving average which assigns equal weight 1 by n to each of the n prices used in computing the average, the exponential moving average assigns decreasing weights with the highest weight being assigned to the latest price. The weights assigned decreases exponentially according to a scheme specified by the exponential smoothing constant, also known the exponent, where the exponent or the multiplier is 2 divided by n plus 1. So usually 1 divided by n, but to give the importance to the resale price, we add 1 to the numerator and 1 to the denominator. So exponential moving averages, the closing price of the day 1200 minus exponential moving average of the previous day means we were expecting it to be 1000, but actually it is 1200. So this difference is multiplied with the exponent, that is just adjustment factor, and this is added to 1000 to compute the exponential moving average. Number of days for which the average is supposed to be calculated. This is what we understand is the exponential moving average. So here, evaluation of the technical analysis. Technical analysis have several supporters as several critiques. The advocates of the technical analysis offer the following interrelated argument for their favor. So we understand that we should use the technical analysis. Why? For that there are three reasons, and of course for this the theory question can be there in examination. Under influence of the crowd psychology, trend persists for some time. Tools of the technical analysis help in identifying these trends early and help in investment decision making. Shift in demand and supply are gradual rather than instant. Technical analysis helps in detecting the shift rather early and hence provides clues for future price movement. Fundamental information about the company is observed and assimilated by the market over a period of time. Hence, the price movement tends to continue more or less in the same direction till the information is fully assimilated, that is fully reflected in the stock prices. Detractors of technical analysis believe it is useless exercise. Their arguments are as follows. So critiques of the technical analysis. First, most technical analyses are not able to offer a convincing explanation for the tools employed by them. Empirical evidence in support of random walk hypothesis casts its shadow over the usefulness of technical analysis. By the time an uptrend and downtrend may have signaled by technical analysis, it may already have taken place. So using past for doing something in future does not make a sense. That is what it says. Ultimately, technical analysis must be self-defeating proposition. With more and more people employing it, a value of the such analysis tends to decline. That's very true. In nutshell, it may be concluded that a rational, well-ordered and efficient market, technical analysis may not work well. However, with imperfection, inefficiency, irrationalities that characterize in the real world market, technical analysis may be helpful. If technical analysis is used in conjunction with, that is together with the fundamental analysis, it might be useful in providing the proper guidance to investment decision makers. Differences between the fundamental analysis and technical analysis. Although a successful investor uses both fundamental and technical analysis, but following are some major differences between them. So there are three differences. First, fundamental analysis. Prospects are measured by analyzing economics macro factors, systematic risk, such as country's GDP, inflation rate, interest rate, growth rate, companies' micro factors like sales, profitability, solvency, assets and liabilities, and cash position. On the other hand, technical analysis predicts the future prices in their direction using purely historical market data and information such as the price movement, volume, open interest, etc. Open interest means the number of traders who are doing a transaction, say in a, that is a trade right now, is open interest. Means number of traders, say, who are going to say purchase call option, that is open, that is interest. Rule: price of the share discounts everything. It means that the price of the security will have incorporation of all kind of information, good information, unfavorable information, everything is incorporated. Price captures everything, the same assumption is there. Usefulness for long term and it is for short term. That's very true. Efficient market hypothesis. Efficient market theory was developed by University of the Chicago professor Eugene Fama in 1960s. As per this theory, at any given point of time, all available price sensitive information is fully reflected in the security prices. Thus, this theory implies no investor can consistently outperform the market as every stock is appropriately priced based on available information. This is the semi-strong form of market efficiency. Stating otherwise, the theory states that no one can beat the market, hence making it impossible for the investors to either purchase undervalued or sell overvalued inflated stock prices, as the stocks are always traded at their fair value or intrinsic value on the stock exchange. Hence, it is impossible to outperform the overall market through expert stock selection or the market timing. That will only way an investor can possibly obtain higher returns is by purchasing risky investment. Search for the theory. When empirical evidence in favor of the random walk hypothesis seemed overwhelming, researchers wanted to know the economic process that produced the random walk theory. They concluded that randomness means the price of the security can move in any direction. Of the stock price was a result of efficient market that led the following few points. Information is freely and instantly available all market participants, and that's very true. Keen competition among the market participants more or less ensure that the market will reflect intrinsic values, that is the true value of the security. This means that say they will fully impound all information. Price changes only response to the new information that is unrelated to the previous information and therefore unpredictable. Means the price can change in any direction. This is what we understand is a weak form of market efficiency. Misconception about the efficient market theory. Efficient market theory implies that the market price factors in all the available information, and as such it is not possible for any investor to earn consistent long-term returns from the stock operation. Although the price tends to fluctuate, they cannot reflect their fair value. This is because the future is uncertain. The market springs surprises continuously, and as a result price reflect the surprises that they fluctuate. Inability of the institutional portfolio manager to achieve the superior investment performance implies that say they lack competence in an efficient market. It is not possible to achieve a superior investment performance since the market efficiency exists due to the portfolio managers doing this job well competitive setting. Means at one point of time everybody is say trying to make the super normal profit from the market, so it makes the market efficient. The random movement of the stock prices suggests that the stock market is irrational. Randomness of the irrationality are the two different things. If investors are rational and competitive, price changes are bound to be random. Levels of the market efficiency: weak, semi-strong, strong. Weak means the past cannot be taken as a base for predicting future. Semi-strong means all information are incorporated. Strong means insider trading is punishable offense. The price reflects all available information. The highest order of the market efficiency. According to Fama, there exists three levels of the market efficiency. That is name of the author, Fama.